Today is May 2nd, 12:02 p.m. Starbucks will be reporting earnings after hours today. And so in this video, we are going to review the unusual option activity we detected today on Starbucks. Second, we're going to analyze them to see what the large investors are doing. And third, we will review our earnings trade based on these unusual options. So before we get right to it, to give us some context, there was this media report just yesterday, May 1st, about these options. So take a quick look at this. This gives us some context as to these unusual options.
The options market is betting on some big. Mike Co's got the action. Mike.
Yeah, we are indeed seeing some big implied moves for all of these. AMD is going to be reporting, looking at a 7.5% move in that one. Ford 5.5%, Starbucks 5%, and Uber 8.5%. I'm looking at Starbucks. This one traded more than 1.5 times its average daily put volume and almost 2 times its average daily call volume in the busiest call contract with a June 115 calls. We did see some two-way flow, but I saw an institutional buyer paying $520 for 500 about 15 minutes before the close. Overall, we saw just shy of 20,000 of those trading.
Okay, so the 5%, as mentioned in this, where is this 5% from the current price? So that's what we want to take a look at, because I found that quite interesting. When we check the current price where we are, if we go up 5%, we are at about 119 here. You'll see the 5%, 118, 119 here. Close to also 120. 120 is also 5% in that range, 119, 120. So down below, where are we then? We're about 107 as well. Okay, so that gives us some context. And so when we look at these unusual options, you'll see here, we have these May 5s here. This is being done here at 9:47. These there's 4 contracts, different contracts here. They're all being done at the same time by the same large institutional investor. So what does this all mean? So let's take a look at the options chain first with the first strike, the 110 strike calls on the May 5s. Okay. So here we are at the 110s. Here we are, current volume 1,000 in comparison to the 3,000 on the open interest, right? So what we think is happening here is that this position is being closed, and they're selling it to close up on it. We are actually still in this position. This is our previous trade. It's not our current trade. We will be closing this, however. This was our previous close when we had done a bullish diagonal trade here, as you can see here. This is the trade, and we did this on April 14. If you haven't watched that video, we'll put that link at the top here on the, if you have info cards, and also at the end of this video, where we had called a bullishness for Starbucks before earnings, and it did happen. And as you can see, it's currently 67 profit out of 108. We paid 108 for it, so that's about, should be about more than 50% now in profit. Well, 62%. Right, so we are closing this position that we did on April 14 at sort of near the last hour, because this is a high theta trade. We have very high theta, so we want to wait till the last hour to continue to get more theta out of this trade. And once we close off this trade, we are going to be left with our current earnings trade. And so what we think is going on is that the large institution is closing that trade and buying the 116 here. You'll see here the volume here is much greater than the open interest. And so we are also buying it. And then what they're doing is also then selling a call spread at the 120s here. You'll also see here our position selling the 120s and buying the 123 strikes. So that's a call spread. Because it's 3-point wide, it requires $300 of buying power. So keep that in mind. And also another thing to keep in mind is that these were done at a ratio of 1.5 to 1. It's not so there's a ratio to this. We did a ratio of 1 to 2 instead, just to keep things also a little simpler. And so what this is doing is we're basically selling this 120 strikes and buying this to reduce the buying power. And we're doing 2 of these for every one of, and to basically finance the 116 strike calls. And so it's going for about $100 or $99 right now at this current time. But basically what it looks like is, let's take our previous trade off. And you'll see here, this is the trade for our current earnings trade. And once we close off that 110, right? So it is bullish as the price goes up, it will be gaining. If it goes down, it will be a loss. So it is a bullish trade. However, if you take a look at this 120, this is where one of our peaks of max profit is. And remember that $19, 119 to 120, that 5% move up. Well, this is where we want to capitalize on, take advantage of that. If it does move as predicted, this 5% move, this would be our highest point of the profit. And then if it continues to move even higher, we can still profit because this is the purple line is still going up. We will never really be at a loss, even though we sold a call spread to finance that. We will never, this blue line never drops below 0. So we are actually never going to, not going to lose on this trade towards the upside, right? Usually if you sell a call spread, if it rallies too much, you would lose money. But in this case, we are not, because we created also a ratio out of this. So that's what we are doing. And if you compare that with just buying the 116s, the reason why we wanted to reduce this cost is because if you were to just buy the 116s, it does have a much more of a cost or risk to it. If you look at this, if you had one of these, and the risk here is this, you see how if it has to break even at 117, right? At 117, and also your theta is much higher at -44 as well. And so what we're doing with our trade here is by selling those 2 call spreads, you'll see that our theta now has been reduced as well. So, and the Vega is reduced at 1.93 as opposed to, you'll see here, this is close to 3.9. We don't want such a high Vega because we know after earnings, it is going to go down. So a positive Vega isn't good for this trade. So we want to sell some options to reduce that Vega as well. So this is why we like this trade more than just buying that. But we understand also that it does take some more buying power when you sell call spreads. And this is one of the things you want to take into account if you have that capital to do that. So this is the trade, and so our break even is at about 117 here. But this is at expiration. We're probably going to just take this trade off right after earnings tomorrow to not have that risk from the FOMC meeting as well. So the break even is actually close to over here at 113. If you're following the purple line, then the break even here is here. This is the break even for expiration date, and something we're not going to wait until May 5. So this is our trade, and and so it does reduce our losses. If it does go the other way down, you'll see that on our trade here, if it drops, we are actually at a loss of just $99 as opposed to if you had just bought this call, your loss is at 165, right? The losses here. So we're reducing our loss, our risk by doing this trade, by selling this. This is another reason why we would sell the call spread. It reduces the potential loss if it goes towards the downside as well. Okay, so please smash that like button. We hope you learned something, and subscribe if you haven't, and hit the bell icon. You'll be notified if you have that turned on, and if we see anything unusual last hour on Starbucks, you will be informed right away if you have that bell icon to notify you when we put videos out. All right, thank you, and good luck on Starbucks. Take care.